participants joining as we approach the official start time. We'd love to just get some audience participation as we go. Um, we've thrown up a poll or a quiz. Poll sounds much more fun than quiz. Up on the screen, we'd love to get your interaction on just as you're thinking about your particular strategy and your situation. What is your top deposit growth priority? And yes, we've all worked with CFOs that say they want it all. They want all the deposits at the lowest top possible cost. And so, but if you just had to sort of say what's the closest priority that you could think of uh, as you're attending this webinar, that's helpful. We'll make sure we hit on uh, on tops. Cool. We got some chat comments too, and so that's a great reminder as we get started. We do love to make this as interactive as possible. So chat those questions, comments. Tim and I will sort of tag team the presentation, and also watching the notes. And so as we approach 3 o'clock Eastern, 2 Central, we are getting a lot of great engagement on the poll question. And so we're great. Well, welcome to 7 Winning Deposit Campaigns webinar. That's the topic we're covering. This poll question is up. We got some great engagement on the poll and some chat comments. And so you guys said checking growth was far and away your number one priority. Also some good interest bearing. Definitely the interest has sort of shifted to savings, money market, away from CDs, cost of funds reduction, and then some just macro strategies in terms of overall share of wallet and new household. And so that's great. I think we've got some information for everybody on this webinar. And again, if you have questions or comments, or please do chat those to us. And so we're just delighted to go through this webinar. Tim and I will be tag teaming it. Tim is the co-founder of Enfusion. We've got a little bio on screen that you can read about. But Tim is going to kick us off with a welcome and a little bit of information about the Enfusion perspective overall. So, Tim.
So thank you everyone for being here today. It's great to be with you. Excited to share this information with you. As is noted on the screen, I'm a co-founder of Enfusion. It'll be 18 years coming up in December. Also spent a couple tours of duty in banking at both First Horizon and AmSouth Bank. Spent 10 years at Axiom Corporation, where I worked with pretty much all of the top 20 banks in the country on the types of stuff that we will talk about today. So kind of been around it from all sides and excited to share more with you about some of the results that we've seen in working with your peers. And to that, we're very excited to announce that we just gone over 25 billion in deposits and loans generated through our programs and working with clients. Almost all of that on a performance-based model where we only get paid for what actually comes in the door. So those are balances matched to accounts opened by targeted households and the product they were promoted during the period in which they were promoted. So we like to think we built a nice little regional bank just with the results of the campaigns that we have generated. Go to the next slide. What really enables and has enabled that 25 billion in results are a couple of unique data sets that grow every day. The national norm is essentially a set of statistics on how consumers and businesses are using retail banking products. The norm is updated every day with fresh data that we take in from institutions all across the country. We've had more than 14 billion data points come through the norm. And so it has a very deep statistical history to it. So by the way, you talk about machine learning. So what happens in our shop every day is we get a file in from institutions around the country, any number of institutions. The machine identifies there's a new data file here for Bank ABC. It runs a set of standardization routines against the data that calculates hundreds of ratios on product ownership and average balances and things like that. We'll show you some screenshots of that. And then the database automatically recalculates. So if you take a statistic like checking account penetration of mortgage households, one of our strategists might go into the database on Tuesday afternoon and pull up that stat and go back in on Thursday morning, and they'll get a different answer because the data is continually recalculating. So we really have a finger on the pulse of trends and how consumers and businesses are using the various products that you guys offer your customers. We have a separate database, which is our campaign tracking norm, built on more than 100 million marketing contacts. It's also updated daily. So that same process, when the machine identifies this client has a file, for a new file, and runs the standardization routines and updates the national norm, that same process identifies, oh, and this client also has 6 campaigns that need to be tracked. It runs tracking on all those campaigns and dumps those results into our tracking database, which also recalculates. And because we're using standardized definitions of bank products and services, segmentation, and campaign response, every piece of data, every campaign that's added to the campaign tracking norm increases our aggregate intelligence on what's working, what's not working, whether that is offer strategy, whether that is channel mix, whether that's targeting or creative, or what any combination of those things. So every day we deploy these tools to help clients understand where are their gaps and opportunities, and what are the tactics and strategies that are proving to be most effective in addressing and taking advantage of those opportunities. So on the next slide, just some examples of how that process or formula or those data assets yield actual results that are meaningful and tangible to clients and measurable. We have a client where we were able to increase their new to bank households by 79% from a multi-year established baseline through these programs. We have another client where we were able to generate the same level of deposit growth as they experienced the previous year, but at 63 basis points lower cost of funds in a static rate environment. Another client in the bottom left corner, we were able to generate about 1,000 accounts at $42 an account. So it's okay to get a $42 cost per account, but it's not that impressive unless you do it over a larger base. And we are consistently seeing payback periods of 2 to 3 months for both loans and deposit campaigns, where you're able to earn a meaningful return in the first year. I'm going to throw it back to Dan to kind of cover the next section, and I'll be back here a little bit later with more content.
Thanks, Tim. And so, just as we start talking about 7 winning deposit campaigns, it's important to think about the industry context. And we have been here before. So whether or not Tim or I or anybody else, the kind of the senior strategist leadership team at Infusion, the banking industry is full of cycles. And so on this chart, we've gone back to 1970, looking at where the Fed funds rate has been, and that's the red line, and what's happened with deposit flows. And so we've been in declining rate environments before. Of course, the most recent significant one outside of the COVID experience would have been in the 07 to 9, 10 cycle. So we've been here before. This is part of it. We've worked through it as bankers, and right now we're seeing from FedWatch that there's a 92% pricing in of at least a 25 basis point cut at the September meeting. So we're in this period of sideways to down Fed funds. The good news is that does not have to mean that deposit flows slow down, but it's great news from a margin management perspective. So that's just where we sit ourselves from an industry perspective. When we think about the top 7 deposit campaigns, one of our key insights as longtime bankers and bank marketers is you get the best bang for the buck in actually thinking about um, campaigns as programs. And so we're going to walk through these one by one, but really one of the best ones out there is business cross sell, right? So the awesome thing about small business cross sell is it generates balances at a very attractive cost. Yes, you do. You can pay interest these days, but it's a fantastic balance, NIM, fee driver, and primacy. So it ticks a lot of strategic boxes. Checking cross sell. Um, one of our partners here likes to say that it's never a bad time to be in the checking business. And you guys said, almost half of you said checking growth is a key priority. So whether or not it's business or consumer, again, it's balances, NIM, fees, and primacy. One that's probably not as well understood is checking upsell, and we'll unpack this more. But again, it has the same benefits as checking cross sell. And so this is an underappreciated one, which we'll talk more about if you don't know what we're talking about. And following closely after that is debit card activation. And the reason for debit card activation is every one of the banks we've ever analyzed, and credit unions, by the way, um, always have a population of people with a checking account that are either not using a debit card or may have underutilized. So they're either not using a debit card or don't have a debit card. And so driving that, of course, there's an interchange effect. That's what all the issuers talk about. But beyond the issuer effect, it has a lot of other benefits and very similar to the checking campaigns. And you'll notice, so the top 4 are all tick all the major strategic buckets. Um, Money market and savings cross sell is great for balances and NIM, right? It can be helpful to primacy, but it's not as strong as the others. And then CD cross sell, also great for balances and NIM. You may be wondering, well, how can CDs help me grow my NIM or help with cost of funds? Isn't that really high cost money? And so stay tuned. We'll talk about how you can actually use it to help if even with a cost of funds goal. And then finally, we put prospect acquisition as number 7 because yes, it generates new to bank relationships and primacy, but it's the most expensive type of campaign out there. And so those are our top 7 deposit campaigns. And really the key insight is moving from a episodic campaign mindset to creating a predictable, profitable deposit growth generation engine requires a mindset shift and systematic discipline, right? So in a lot of ways, it requires shifting the mindset from doing discrete campaigns to thinking of campaigns as programs. And so the way that we approach this, and Tim will come back and go and round out in this in a lot more detail, but we view it as a continuous approach, a continuous process grounded in some very deep relational analysis that feeds directly into planning, that feeds into doing campaigns and tracking and refining those campaigns as a continuous programmatic circle. Again, not a one-off kind of random acts of marketing approach. And so to give you a taste of what Tim is going to talk about more, every every one of your customers, every one of the bank customer bases we've ever analyzed, or credit union member bases, is composed of mixes of existing households. So we haven't yet seen an institution that has 100% penetration of checking. And even some of the ones that are higher penetration on checking have opportunities to drive greater transactor or primacy even among that checking base. And so we'll talk more about that. But when we think about the fundamental financial needs that the institution meets for the consumers, they map very nicely to buckets of your balance sheet and income statement. So uh, we borrow funds from high depositors by meeting a savings need. Um, we lend those funds out to active borrowers. Of course, we can also use the excess funds to buy securities, but meeting that need for credit to the active borrowers is a way to deploy those funds and generate a yield. And then transactors are a tremendous source of fee income and stickiness. And we try to, meet those needs and generate fee income primarily by managing the cost. And all of that is within the context of applying data to understand which one of my individual customers have the best capacity and propensity for each one of these fundamental needs. Um, and so think about capacity as the ability to buy, i.e., they have the wallet size or the credit profile. The propensity is the inclination. And so applying data can help us make this not a qualitative exercise, but a data driven to understand which one of your customers have the characteristics. And then awareness is moving from just the potential to actual, right? So people have always had awareness as an aspect. There were fewer tools before the digital era. With digital, we have a lot more insight into what's the interaction of the number of impressions and clicks and engagement to translate the data sort of potential energy to actually conversion that puts money in the bank. And so just to give and so we benchmark each one of our customers' penetration on those concentric circles to understand macro opportunities and risks to feed directly into growth potential. And so we take that data-driven discipline and the planning, and then we'll like I said, we'll come back and dive into exactly how we identify these opportunities. But when we walking through, the number one winning deposit campaign is small business DDA cross sell. And so here, the goal is to expand loan only or single service business relationships to add that primary relationship. So every institution we've ever analyzed always has some portion of their population that are loan only, or even increasingly maybe other products and services, but not the primary DDA. And so this is a very much a game of inches of building up base hits every day, knocking down consistent growth. And so by putting in place a consistent business DDA cross-sell program, banks are seeing consistent quarterly response rates, the graph on the top right, but also at really nice balances, right? And so small business is more granular than commercial, but it's also a lot bigger bang for the buck than consumer. So we're talking about, you know, $47,000, $67,000 average balances, which are multiples of consumer. So yes, the population is smaller, but it can be very consistent, larger tickets. And so the combination of targeted audience and essentially high ticket size, we see very commonly it's easy to get a 1 to 2 month average payback on the marketing investment for a consistent data driven program that generates low cost deposits, stickiness, and oh, by the way, can be implemented very quickly. If it doesn't require changing out products, doesn't require hiring bankers. This is about driving more demand into your current infrastructure. And so that's why we see it can be a very attractive 1 to 2 month kind of average payback, and why we say it's the number one winning deposit campaign. Number two is very, very similar, is consumer checking cross-sell. So here, the goal is to lean into capacity and propensity factors to enhance the existing relationship by adding that checking account. And so what we found by doing this over decades and decades is this is definitely not a spray and pray approach. There are pockets of population that may not have a checking account and may never get a checking account for you based on the current profile of their capacity and propensity factors. And so by having a targeted checking cross-sell program, you're enhancing relevancy. You're talking to people who have the best chance of to respond. And this is also not relying on kind of one size fits all um, logistic modeling or next best purchase. This is a very machine learning driven approach that's compliant, but it's reaching people that have the right level of propensity as well as the capacity to respond so that they're engaging with your message and then rewarding to you. And so it's very common to see results like $12,397 average new checking balance per responder. With the right kind of targeting, right kind of offer structure, you see that. We're seeing also very commonly 2 times the impact on net deposit household lift. So as we're driving primacy, the customers responding us, rewarding the institution with a net wallet share expansion beyond just the checking account. And so it's for those factors why we see it's very common to see a 3-month average payback. And it doesn't necessarily require a cash incentive for building a relationship for current customers. Sometimes with the right data and targeting and channel mix, it requires just a nudge. And so we had one client tell us that they had tried to do checking cross sell themselves with some, kind of unsophisticated email programs, in their words, not ours. That then after they used Infusion for a check and cross sell, they were seeing results 10 times higher than what they saw on their own. It's that combination of all the measures that Tim was talking about earlier, of the right profile of targeting, the right channel mix, the right creative package, and the right offer strategy all add up to a really rapid return on investment in driving low cost and primary relationships. Okay, checking cross sell is probably one of the least understood campaigns. It's not uncommon to hear things like, "Oh, wait a minute, I already have a checking account. Why do I want to communicate? Why do I want to communicate something else?" Well, the reality is, uh, there are pockets of customers that yes, they have a checking account, but you are not yet their primary relationship. There is an underfunded profile of people that have the potential to expand the relationship with the right targeting and message strategy. And this is definitely an area where we see you don't need a cash incentive. And some of this could just be life stages change, right? When the person originally opened the account, they might have been a student, non-interest checking, basic checking account. Since then, they've had multiple life event changes. And so communicating to them that there's a better account for their needs, to upgrade that, make it very simple. We're seeing the results are rewarding the bank with a net increase in checking balance of similar to what we're seeing on checking cross sell. In some cases, it's even higher. And so we're seeing things like 11,948 average net increase in checking balances for responders. So they're adding to the checking relationship through a data-driven messaging strategy. And it takes some pretty sophisticated tracking and targeting to uncover and then track those opportunities. It's not quite as simple as just tracking even a response rate, let alone a click rate. But we see really nice 2 to 3 month average payback on the marketing investment from checking upsell, doing these kind of programs for institutions all over the country. Debit card activation and cross sell. So here, the profile is the checking. There is a checking relationship existing, but there is not debit card activity. And will everyone use debit card? No. We know there are certain people, certain households that they prefer to use credit, but there's always opportunity. We have not yet seen a bank that tapped out, that are driving debit card programs and not seeing a response. And some clients, we've been doing debit card activation for over a decade. And so now, of course, the quantities drop as you're driving that response, but this is all about getting the household to add a debit or use that debit card when they haven't. And so, yes, you see increased fee income from interchange, but the real big payoff is driving that higher primacy. And you see the result in as an example, 5,903 average increase in low cost checking balances. So as the fee income engagement goes up, the overall primary balances the checking household increase as you migrate from becoming uh, a uh, checking provider for that household to the primary checking provider, the top of wallet card. Now, in this case, we do see a little bit longer average payback on marketing investment, but we rated debit card cross sell as number 4 because it's such a powerful, low cost um, provider, and it has that kind of quadruple whammy of balances at a low cost and fee income and primacy. All right, everybody tracking us so far. Um, so we've talked. The top 4 are all about driving DDA and DDA primacy. As we transition into the interest bearing, one of the key insights that we gleaned over many years is what we call what Tim dubbed the virtues of modest pricing. And so here is a relatively recent example where we controlled a lot of variables through the campaign tracking database, isolated same time period and different offer amounts, and looked at the results. So at this particular point in time, a 475 offer did win in response rate. Um, and, but then a 425 or lower had a lower response rate. And so if you're trying to drive volume, yeah, top of market can drive a lot of volume, but look at the net new money percentage. So the more moderate price generated, and in fact, the most modest price generated 2/3 net new money, and so if you're looking at driving kind of sustainable results, you can get interest rate savings and still acceptable volumes as you go forward. So yes, balances will be through the door at a kind of a top of market or above market price, but you can still generate sustainable growth at more moderate pricing and really attractive net new money stats. And so when we talk about money market cross sell, and we work with clients on a combination of things. But one of the things that the data-driven digital execution really enables is a very laser-focused target that aligns with your ALCO. So on money market cross sell, by setting this up as a dedicated communication track, you have the ability to um, moderate rates up or down based on the results you're seeing and communicating with ALCO. So you can what that enables is experimenting with more moderate rates to see what kind of baseline you can achieve. And of course, Infusion is bringing bear the latest insight from all of our work with other clients to inform this. So you're not shooting in the dark, but you can start out more moderate and only increase the rates if you need to get more volume, and then also drop it down. We also advise all the time on the trade-off from new retention and loyalty and new money percentage, right? So when the stricter clients get on new money requirements and those kind of things, or promo terms, that can enhance new money with a trade-off of loyalty and an overall response, of course. But the best practice tracking is coming to bear on what's the right mix of all these things, including rate. And so we've been able to see clients get a 10 basis point type effective cost of funds with a pay per performance structure. And so they're able to harvest really nice NIM savings. When we work on a pay performance basis, it essentially helps them see that on a variable basis. We put our skin in the game, so to speak, and so helps them get essentially a variable, creates marketing being a variable cost that they can directly stack against the volume generated. CDs. So we talked about, CDs are very much and they're definitely the highest cost customer money that you can pay. Now we argue that usually that's better than paying wholesale funds. If you need really fast, sort of non-wholesale, non-brokered, our friends over at Quick Rate can help you get that on a customer basis. But on the virtue of using CD rates in a customer context, it helps build relationship because there are customers that want um, the kind of savings vehicle provided by CDs. But one of the most significant effects that we see when we start working with clients is they're able to achieve. We're almost always able to help them achieve a 25 to 75 basis point cost of funding savings versus other promotional options. Maybe it's campaigns they were already running that we help them right size. And then if that, of course, translates into 100 basis points or more versus wholesale funding options. The way we do that is through targeted, a very thoughtful targeting and channel strategy. And so, we're able to reach members of the household with the capacity and propensity to increase their deposits. And so but it's on a targeted basis. And so you're not having to, communicate this to the whole world. And so by working with them to driving down that cost of funds, you're just an example. If we're helping you generate 42 or $52 million of quarterly CD production at a 25 basis point savings versus other alternatives, that's over $500,000 annualized cost of funds benefit. And so in the poll at the beginning, we heard that some of you were interested in understanding cost of funds improvements, being very thoughtful and having a continuous improvement on CD promotion. This is where you can save some real money by being thoughtful and long term. I worked at a bank that will remain nameless, where when we tried to make deposits or CDs too promotional, we would almost get into a panic, go out there with a big rate, plaster all over the billboards, and then that would solve the short-term funding need, but then create this big bubble, 7, 9, 13 months down the road when all the CDs matured. And so the alternative is taking a very thoughtful, continuous, data-driven approach that you're helping to build customer relationships, meet their savings need, but at a moderate cost of funds. And so the other benefit of that is you're not building your book based on hot money, right? And so that is that's one of the benefits of a approach. And by running CD and money market savings cross sell programs simultaneously on dual tracks, it gives you a lot of strategic flexibility to be able to pull levers to either amp up or amp down the promotion of it, but also the rate based on your ALCO. So you can afford to be more moderate on CD if you're also generating a continuous stream of it and also money market savings. All right, I want to make sure we get through this. And so the last one on our winning deposit campaign is systematic prospect acquisition. And the key thing here, and we've been able to help clients really turn around their new to bank story through a disciplined, systematic process that's rooted in data. But this is a journey, not a sprint. And so on the right, we're showing a progression. This is an actual program that ran for more than 2 years with a client where you can see between Q1 and Q4, we doubled the impact that they were seeing in terms of response rate on the acquisition program, and then sustain that benefit out there. Prospects is a tough game. Anybody who's ever made sales calls understands that. But it's a game of inches and a game of discipline. And so we've been able to really apply data, channel mix, audience targeting, offer strategy to generate some sustained and predictable outcomes for clients. And with the right approach, we can see payback as low as 6-month payback, which is really amazing when we think about when I compare that back to what I saw when I was at the bank. And so that's just a taste on how prospect acquisition can be successful, can be a winning arsenal in your deposit playbook with that discipline and the right data-driven multi-channel approach. And so now Tim is going to unpack more about the approach we use to even uncover and help you prioritize these type of opportunities at your institution. Tim?
Okay, can you hear me?
Yep.
Okay, awesome. So obviously, the whole point of this is to root your growth strategy in a deeper analytic framework. And the way to go about doing that is to have a realistic sense of where you're starting from, which is where peer benchmark data can be so helpful to help me, clearly identify where I'm starting from so I can develop a path to where I'm trying to go. So these are the types of questions that we think are really important to ask, particularly when you're thinking about deposit growth. Number one, how concentrated are my deposits? Deposit concentration has always existed in banking. It's the 80-20 rule as manifest in our industry, but became much more prominent when SVB failed a few years ago. And you might be surprised how much these ratios vary from bank to bank. The important thing is to know how concentrated are your deposits within customer relationships, where do you have exposure, and where do you have opportunities to deepen the relationships you count on to fund your balance sheet. Single service usage is something every bank has. No matter how hard you try and work at cross sell, you're always going to have some of it. But understanding your relative amount of single service usage helps us to assess cross sell potential, but also attrition risk. New household production, Dan talked about that. You want to understand your volume of new households, and particularly if you take the number of new households you attracted in the last 12 months and divide it by your total number of households, that gives you a growth ratio that we can help you compare to your peers to get a sense of, am I growing at a reasonable rate? When you combine that sort of data with household per branch data, you can really get insight into the utility of your branch network at an overall institutional level or regional level or individual branch level. And we help clients to really assess those types of metrics. Underfunded accounts, Dan talked a little bit about this. I'll specifically focus on money market. Every one of you has customers who own a money market account with you and who have the wherewithal to carry a balance in your top tier, but their current balance is in your bottom tier. And so one of the most efficient per dollar ways to grow deposits is what I call money market activation, encouraging customers to increase balances in order to earn a higher rate based on the tiered structure of your product, but also to fund up to the level of their potential. Very efficient way to grow because the account's already open. Accounts per household can be deceiving. Wells Fargo taught us that a few years ago. But when you pair it up with or match it up with product penetration type of metrics, you can really get a sense of, where you're missing opportunities within relationships. And then, of course, to me, relationship banking starts with where you're meeting both the deposit and a credit need within a relationship. So understanding your overlap between checking and credit product usage so that we can assess where do I have opportunities to grow checking within my lending base, and where do I have opportunities to grow loans within my checking base. Those benchmarks give you realistic sense of how much that opportunity might be. So I mentioned deposit concentration. This is one of my favorite ways to look at data because it intersects a balance sheet view with a customer relationship view. We believe you don't have to choose between managing portfolios and managing relationships. You can do both at the same time, but to do it, you've got to be able to bring key data like this together. So what we have here are 6 ranges of deposits from $1 to 250 plus, 250,000 plus, the number of relationships that hold that level of deposits, the percentage of deposits they control, how many have checking, what's the average checking balance, how many only use one service with the institution, and then how many what percentage have credit. And you have indexes interspersed throughout the table which are where we compare the individual metric to the peer or peer group norm. So an index of 100 is equal to the average peer or average bank. And so if your index is 120, you're 20% above. If your index is 80, you're 20% below. So one of the things we do here is aggregate these top four rows, which is this bottom row, high deposit households. So this is $10,000 or more in deposits on this bottom row. So for this client, that's 115,000 households, which is 38% of households. They control 94.8% of deposits. So that 94.8% of deposits controlled is an index of 98, which is right at the norm. Index of 100 is norm. Index of 38% is an index of 94. That's 6% below norm. And so they're a little more concentrated than norm because they have a lower percentage of depositors controlling a normal percentage of deposits. In the top tier, 250 plus, which you start getting to uninsured deposit issues, it's 2.2% of depositors control a third of deposits. And that index of the 2.2% is half the norm. So they have half the percentage of depositors in that tier, but they're still controlling a third of deposits. So the ratios are interesting. What's important, though, is how strong are my relationships with these 38% of households that are funding 95% of my balance sheet. So then we would answer that question with, do I have their core checking? Do they use one or multiple services with me? And do they have credit with me? So for this institution, 95% of households have checking with the institution. That's 17% above norm. That's awesome. But they still have about 5,000 households in this tier that don't have a checking. The ones that do have an average balance of $35,000. So, if you're going to spend $1 to grow checking, you want to focus on these top tiers where you get these very high average balances. And at the same time, when you're successful, you proactively retain relationships that are critical to your funding base. So anytime you can spend one marketing dollar to get disproportionately profitable checking balances and prioritize retention benefits, you want to spend that dollar every day of the week. And by the way, your next best product models, they don't pick up on that type of nuance typically in terms of prioritized targeting. I don't have time to get into it, but you also want to benchmark your single service usage and credit usage in these key segments. Credit is an anchor on the deposit. If I have 10 years left on a mortgage with you and I have a $35,000 checking account, the chances that checking are still going to be there in 10 years are greater than if I don't have any credit with you, because the credit becomes an anchor on the deposit. You can take then an analysis like this and take these high deposit households and then break them out. So here's our 116,000 high deposit households. You can look at product ownership rate and average balance, and you can look at how those compare to norm. We use green shading for favorable comparisons and yellow shading for below norm comparisons. And so you can start to get a sense of where do I have gaps and opportunities. And then you can look at that in product penetration, where this 100-yard line is the average bank. And you can see that this client is 86% below norm for money market penetration. And that's a quantifiable gap. We can do a math calculation to tell you, if you just get to the norm, what would that add in terms of money market accounts and balances? You can see they're also a little bit underfunded on average money market balance as well. And then you can see the various other products. They have a 28% gap in home equity penetration of high depositors who have high credit quality and tend to have high property values. Ultimately, what you want to do is you go through a series of these types of uses to identify audiences that the data says have high capacity and high propensity to grow in categories like checking, CD, money market, home equity, installment loans, business lending. And so one of our mantras is the best digital marketing starts with the audience, not the channel. So these are discrete audiences that we can match to digital channels and deploy marketing like the marketing that Dan showed earlier. And this becomes a plan whereby you communicate that what you have to offer to these audiences about these subjects, and you're measuring all the way along. What we're able to do is to take the quantities for individual clients and dump them into our tracking database and say, if these segments continue to perform at the same level as they're performing for your peers for the same types of offers, what would that yield on a calendar like the one we just showed? So for this client, we had about 25 million in checking balance opportunities, 2,400 accounts, 133 million in other deposits, about 100 million in loans. And then we have halo effects of 17 million, which is additional products opened by responders during the campaign which they responded to. And so overall, it adds up. When you add the halo to the total, it's around 280 million in projected balances. And so clients are able to take this, compare it to what they're seeing in their current campaigns, and then come back and say, can we craft a calendar that, based on the resources we have available and our priorities, our business priorities, and with the pay for performance, we're able to do that in a performance environment where we can set an annual maximum, guaranteeing the client will not pay more than their budgeted budget limitation, but they could end up paying less if the results don't materialize. So if we go to the next slide, Dan, do you want to kind of wrap us up here?
Yeah, happy to. Yeah. So, obviously in 45 minutes, our time was limited. We wanted to really focus on those 7 winning deposit campaigns, which really think about campaigns as programs based on, experience doing this with hundreds of your peers around the country. And so really the key takeaway is a systematic discipline process is essential for getting winning deposit campaigns. Random acts of marketing does not work. And profitable deposit growth starts with a data-driven assessment of your opportunity. It's much richer, informed by third-party data and peers and the perspective of people that have a multi-institution perspective, like Tim and myself and those on the teams. And your peers are monetizing the kind of opportunities and making progress in the type of priorities that you talked about at the beginning of the call that would be important. And so that's the key takeaway. We would love to follow up with you guys if you want to dig deeper on any of these topics. We will send out copies of the material, but if you want to reach out to either one of us directly, our email addresses are there on the screen. And frankly, we'd love to give you a complimentary opportunity assessment, like we touched on the last few slides, to help you uncover and prioritize and build the case for what are those profitable deposit growth opportunities at your institution, based on what's important to you and your executive team. And so we would be honored to help you out, just like we've helped hundreds of your peers. Thank you. And thank you for all the questions and engagement along the way.
Thanks, everybody.